Peter Schiff, CEO at Euro Pacific Capital. He joins us live out of Connecticut. Peter, always good to see you and appreciate your time. You're one of these guys who is looking for the right kind of jobs growth. With the manufacturing number that we had out overnight, the ISM, does this make you a little bit more positive?
No, not really. I would not get excited about the U.S. economy. I think we're just coming off of a stimulus-induced high, and I think as it wears off, the hangover is going to be pretty bad. You know, and the jobs that we are creating are the kind of jobs that make us poorer. They're not the jobs that make us richer. We're creating a lot of jobs in the service sector, but then it makes our trade deficit get bigger because now we have to import the things that we're not producing ourselves. And so it actually exacerbates the underlying economic imbalances that are at the source of our real macroeconomic problems here in America.
So the better than expected manufacturing numbers, I mean, aren't these the kinds of jobs that will let Americans continue to consume and spend? Doesn't that number give you a bit of relief?
No, well, we're going to create some manufacturing jobs, but not nearly enough. 95% or so of the jobs are going to be service sector related in healthcare, in education, in retail, in finance. Those are the sectors that are too big. Those are the sectors that are going to have to shrink along with the government in order to make room for more productive private use of capital and labor in America. We've got a very, malinvested economy. Our interest rates are much too low. As a result, we don't save enough, we don't produce enough, we borrow too much, we spend too much. All this has to change, and I think ultimately it will. I think we're headed towards a dollar collapse and a sovereign debt crisis here in America, and then we're going to wake up and finally have to confront these problems.
A lot of macro concerns out there, no doubt about it, Peter. But are you surprised at how quickly equities in the U.S. turned higher on this ISM report? And coming up this week, we've got ADP on Wednesday, jobless claims on Thursday, non-farm payrolls on Friday. Do you think the market might do the same thing again if we get a positive surprise to the upside? They're just going to take off.
Well, I think that what's really behind the stock market is inflation. I mean, people understand that dollar is losing value. Fiat currencies around the world lose value. And so what are you going to do with them? You really can't buy bonds. I mean, bonds are the biggest bubble that's yet to burst. So you have to put your money someplace. So people are putting their money in stocks. I think people would be better off buying gold here. Gold stocks, I think, represent a tremendous value. And if you want to buy, non-mining stocks, I mean, look around the world. I'm much more excited about your part of the world, about the Asian markets, than I am about the U.S.
Forgive me, Peter, but did I hear you correctly when you said that you were warning off a dollar collapse and a sovereign debt crisis in the U.S.? What makes you so
negative? I mean, what you're looking at in Europe right now, this is just, the warm-up. The main event is America. I mean, we have the same problems in Europe as that Europe does, but in spades. I mean, we've got more debt and we're less able to service it. We've been able to keep, the hounds at bay because we've got this printing press, but that's ultimately going to be our undoing. When our creditors realize that inflating away your debts is worse than defaulting, we're going to have a serious problem.
Well, so here's the thing. We've got what a lot of people think looks like a bond bubble. What is going to pop that? What's going to be the trigger?
Well, personally, my best guess is it's going to be starting in the foreign exchange market. You're going to see weakness in the dollar. The dollar has been quietly weakening over the past couple of weeks. Despite all these negative headlines coming out of Europe, the dollar is going down. I mean, it hit like an 8-month low against the pound, a 2-month low against the yen. It can't get any traction against the euro. I think the dollar is going to break. You're going to see bigger increases in commodity prices. Look at soybeans and $15 beans. I mean, oil prices closed above 106. All of this is a function of inflation and a weakening dollar. And I think as the dollar really starts to weaken and you start to see bigger increases in commodity prices, that's going to put pressure on the bond market and put pressure on the Fed to raise interest rates to try to prop up the dollar and fend off this inflation. The Fed will not do it. The Fed knows the only thing propping up our phony economy is 0% interest rates and quantitative easing. And I think when the market figures this out, it's going to put even more pressure on the dollar. And ultimately, I think that is what's going to prick this bond bubble. And when interest rates rise, and they're going to rise sharply in America, we've got no choice. We're going to have to restructure. We're going to have to ask our creditors to take a haircut, just like the people who own Greek bonds. Yeah. And if we don't do that, then all we can do is print money. And I think if we go that route, the haircut's going to turn into a crew cut in terms of real purchasing power.
Yeah, could be just a Yeah. All right. Listen, a lot more to talk to Peter Schiff about at Euro Pacific Capital. Email us if you have a question for him, squawk@cnbcasia.com.
Okay, let's get back to Peter Schiff, CEO of Euro Pacific Capital, joining us from Connecticut. What do you think, Peter? How long can rates in the United States remain low? And I'm looking at a quote in your notes. You say, the current rally is really an unfair gift to those who have stayed in U.S. debt for too long, sponsored by those who made wiser choices. Could another downgrade of the U.S. be the catalyst to get people out of treasuries?
Well, yeah, I agree with Bill Gross. I think, unfortunately, though, he's sugarcoating it. It's much worse than he says. And I'm not going to rate for the rating agencies to move. I mean, as far as I'm concerned, U.S. treasuries are junk bonds. And the only reason that the U.S. government can pay the interest on the debt, and I say pay, in quotes, because we never pay our bills. We borrow the money, so we pretend to pay. But the only reason we do it is because the Fed has got interest rates so artificially low. But once interest rates rise, the U.S. government cannot afford to service the existing debt, let alone actually have to pay off maturing debt if our creditors want their money back.
Okay.
So I don't think we have that much time before the crisis.
Okay, Peter, so what options do investors have? If they want safety, where do they go if not U.S. treasuries?
Well, no. I mean, you got to sell your treasuries. You need safety from the dollar, and all treasuries are is future promises to pay dollars. So you want to get rid of your treasuries. You can own gold. You can own other currencies. I mean, certainly I would rather own in there, the RMB or the Hong Kong dollar. Eventually, they're going to break the peg on the Hong Kong dollar. Maybe they'll peg it to the RMB, and then they'll be able to rise. But, you can buy the Aussie dollar. You can buy the Scandinavian currencies, the Canadian dollar, the Swiss franc. And there are a lot of stocks around the world that you can buy, particularly in the Asian markets. I think there's a lot of value in those shares. But you need to stay as far away as you can from the U.S. And as far as QE, unfortunately, we're going to get QE3. We're going to have more QE than Rocky movies, because the only thing keeping this phony economy going is the QE. And the minute you take it away, it's going to collapse. But, the sooner we take it away, the better, because this phony consumption, government spending, borrowing economy has to come to an end so that we can replace it with something that's viable.
All right, listen, so Peter, that's one way of looking at that. This is Fed manipulation that's keeping yields so low, and once the Fed, as the big supporter of that, steps aside, yields are going to spike and we've got a problem. Could it also be, though, that yields are so low, still below 2%, because the bond market is trying to flag weakness in growth for the U.S. economy going forward? I mean, that's a pretty simple answer.
I don't think so. You've got the Federal Reserve with its Operation Twist buying about 90% of the long-dated treasuries. You've also got other foreign central banks in there. I think this is total manipulation. I think if the bond market was free of government interference and it was just legitimate investors expressing their preferences, you would see a collapse of the bond market. Nobody believes that a yield on a U.S. Treasury for 10 years sub 2% is a good deal. I mean, inflation is much higher than that. I mean, even the government's own CPI numbers, which grossly understate the true rate of inflation, the number is higher than that. So I don't think anybody would be buying treasuries with their own money. Nobody's buying these treasuries to clip coupons and cash them in when they mature. This is a speculative market. It is hyped up on government, and it's going to collapse, just like the dot-com bubble, just like the housing bubble, only this one is bigger.
What percentage of investors in the market do you think are legitimate investors? I mean, most of the big players, they're hedge fund managers, they're insurance companies. They're trying to get a return on their buck. If they sit out now and you say there's round after round of quantitative easing coming, they're going to miss a rally.
But eventually, see, the more quantitative easing they do, the less bonds are worth. Because the problem is, in order to buy bonds, the Fed creates dollars out of thin air. But the more dollars it creates, the less the bonds are worth. Ultimately, the QE is going to collapse the bond market.
Okay, Peter, thank you so much for joining us today. Good to have you on the show, as always. Peter Schiff from Euro Pacific Capital. Some interesting themes there.